Welcome to Global Money Talk, brought to you by Sampro TV. Greetings to all of our viewers from across the United States, Korea, and around the world. We are coming to you live from the floor of the New York Stock Exchange in New York City, the financial capital of America. I'm your host, Remy Blaire. And this morning I am joined by Tai Wong, the independent proprietary trader. So good morning and happy Monday to you.
Good morning, Remy.
Well, we have a busy week ahead of us when it comes to Fed speakers as well as economic data. So first and foremost, let's start out by talking about last week's equity market rally on the heels of that Fed rate cut.
It's certainly you get a lot of Fed speakers because they've been muzzled for a week and a half, and I think we're sort of we want to hear from them and hear what they think about what just happened, because that's in some ways, at least initially, more important than the data, because what are they actually thinking? What is this 50 basis point cut? And we've just had 3 speakers this morning. But in terms of the markets, I think this was a pleasant surprise to the markets. It wasn't, they weren't sure they were going to get 50 basis points, but it's 50 basis points. It wasn't as much projected for the rest of the year, but that's only a snapshot of what happens now. Some markets got 125 basis points priced in at the moment, while the Fed only saw 100 in the dot plot. But what it says is the Fed is not going to be behind the curve. They're watching very carefully, and rates finally are coming down, which is great. Which is on the margin great for business, great for the stock market. I mean, I think we'll need many more rate cuts. With rates down maybe 4%, 3.5%, 4% before it really, I think, hits the economy. And as Chair Powell likes to say, monetary policy works with a substantial lag. But this is the news that the market's been waiting for the final quarter of the year. So I think it looks like it's going to be a very good quarter, although there's a lot of event risk.
Absolutely, because when we think about event risk, it is a U.S. presidential election year, and heading into this year, there are expectations that the Fed Reserve would execute many rate cuts, but here we are about to enter the month of October. We're in the final full trading week of September, hard to believe, and wrapping up Q3, and we finally got the rate cut that we expected. For some, it might have been bigger than expected, but it has begun.
It has begun. And if you listen to Chicago Fed President Austin Goolsbee, who was just on the wires, and he is the most probably the most dovish member of the Fed. I mean, he's a former Obama high official, and he said there will be many more rate cuts. I'd like to freeze the employment market right here, which I think literally what he said. But we have rates here, many more rate cuts. So that sort of fuels the fire. But at the same time, he is probably the most dovish member, so you'll take it with a grain of salt. The market cares when dovish people, dovish members speak hawkishly, and vice versa. Neil Kashkari, federal Fed chair of Minneapolis, a very interesting fellow actually. He worked for the Bush administration and the Obama administration during the great financial crisis. He's an ex-Goldman guy. He helped out the Bush's Treasury Secretary at the beginning of the financial crisis, and I actually met the man. Really nice guy, very thoughtful. He was running for governor of California as sort of a centrist Republican. He didn't get anywhere, but then he became the federal regional president of Minnesota. And he's a little bit of a weather vane. He was very dovish, and then when inflation hit, he became extremely hawkish. He literally went from one end to the other. And a little bit like former St. Louis Fed President Bullard, who was kind of the same way. You could feel how the winds were changing if you see where they stood. I mean, it's not meant to be a bad comment, but they feel the difference. And he says, I could see another 50 basis point cut. So I think the wind is at the back of easier policy. We've got some room to go. So that's all these things are helping the market.
And as you mentioned, we're getting plenty of Fed officials speaking this week, and this does come after their blackout period, because heading into the Fed Reserve meeting, they do have a media blackout period. But this week, as you mentioned, that they are allowed to speak publicly, so it'll be interesting to see what they say. And also at the end of the week, we get a key data point, which is the PCE, something that the Fed closely watches.
They do. And I think they were ready to cut earlier in the year, but then core PCE popped up for 3 straight months, and it really spooked them.
Yeah.
So it's not one print that's going to spook them, but if you get a trend of higher prints, this could mean, well, we'll only go 25, or maybe we'll pause in November and wait for the picture to clear in December. So this is the inflation figure that they really do care about. And the last word on Fed speakers is, I noticed that it was a little unusual that Governor Michelle Bowman, who cast a dissent, the first dissent by a governor, I think since 2005 or something like that, and she wrote sort of a piece about it, not what she was concerned about, and it's meaningful that she wanted to put it in writing. Was, I know inflation has come down, but it's still above our target. I'm not really comfortable with it yet, and the jobs market is still healthy, and most importantly, Americans are still spending. So she really sort of wanted to get her piece out there. And you don't often see, you don't get that many dissents, but you don't often see a comment with a dissent. It's not the Supreme Court.
Yes, and as you mentioned, she was the one person who dissented to that supersized jumbo cut from the Federal Reserve of 50 basis points last week. So I think, Tai, given the rally that we saw on Thursday and the fact that the Dow, NASDAQ, S&P 500 all closed higher by about 1.5% last week, it does speak to the market reaction on the heels of that Fed rate cut. But I think this is a great time to take a look at where the major U.S. stock averages are trading on this Monday morning. So right now, it looks as though the Dow Jones Industrial Average is nearly unchanged on the session after trading on both sides of flat this morning. Meanwhile, the NASDAQ Composite Index is slightly higher, eking out a small gain of just 18 points, and the S&P 500 looks nearly flat as well and is higher by just 0.2%. Now, it's interesting because we've been getting PMI figures from around the globe this morning. Here in the U.S., it did come in better than expected, but in the Eurozone, we're seeing a decline below that 50 level.
Yes, yes, and you saw a dip in the euro dollar when that happened. I woke up this morning, I'm like, euro is much lower. No, it must be some sort of poor data. It was, and it's since recovered. But I think Europe has a much different economy than the United States. It's much more unionized. The regulations are much heavier, and they're just not primed to be able to grow the way we have. And also, it's more of it. They are free market economies, but there's a lot more government sort of tweaking in there. So they'll have national champions, like Germany would have like a Mercedes-Benz that they will always support. And we can debate at length about whether or not we should have them. You could argue that in the U.S. we should have companies that we always want to make sure do well because for national security reasons. You could argue that Boeing is one of them, but they might not get the official backing that say Airbus does. But Germany this morning, just before we came on the show, the headline that Germany doesn't want Commerzbank taken over by Union Credit. So this is more. There's a lot more interference in sort of the economy in Europe. And part of that, it makes it's hard to fire people, so it makes the economy less flexible. So I think sort of a lower inflation, lower growth is perhaps more of a risk in Europe than it is here.
And I think you bring up an important point because the way that the economies function in Western Europe, especially the EU nations, are quite different when it comes to the U.S. And since you brought up Boeing, I do want to talk about the company. So in New York Morning Trade, it does appear as though shares of Boeing are slightly above the flat line this morning. But of course, we're keeping a close eye on what happens to that company, especially given what's happening and how much they're losing on a daily basis as long as the machinist strike continues and the furlough for white-collar workers as well.
Right, and people believe to be 100 million, perhaps more a day. They've been trying to conserve cash in many different ways. Haven't seen any sort of proposal by either side. Now, there's a federal mediator involved. I suppose you come out and say we have a miracle agreement, but it sort of doesn't feel that way. And I think how Kelly Ortberg starts is really important for Boeing. Do I? Because if he really gives in, then he encourages sort of other actions, and it also encourages, we spoke about last week, actions by labor overall. So the good thing about Boeing is they still have, I think, 5,400 jets on back order. So they once they get their house in order, and it may take, I would say probably years to get their house in order. They have, they're going to be making a lot of planes. There's going to be a lot of money coming through, but in the interim, it's going to be painful. And the stock price, it just doesn't look healthy. It has no, has really no energy. I think they do have a little bit of, armor in terms of they are the U.S. One of the two global makers of planes. So I think they'll come back, but I'm looking for a little bit more value in Boeing before I'd like to get my hands in.
And of course, we'll have to keep an eye on any headlines that appear regarding Boeing as we head into the new quarter as well, Tai. But while we're keeping an eye on headlines, let's take a look at China. So overnight, the PBOC announced liquidity measures as well as a cut to short-term policy, and apparently they are announcing plans for a rare economic briefing tomorrow. So what can be expected from that?
This is really interesting. This economic briefing by their top regulators is unusual. And we'll probably be talking about it this time tomorrow because it'll happen overnight. They did cut rates, kind of largely expected. I think it was a 14-day reverse repo rate. They injected liquidity in several different ways, which is not unusual because there's October 1st is sort of that great national holiday, the commemoration of the revolution of 1948-49 that brought the People's Republic of China into existence. So the country is basically shut for a week. Not quite as big, but nearly as big as around China, the Lunar New Year, when the country shuts down for several weeks because so many people it's the greatest migration of people in history every year because hundreds of millions of people go home. I don't think it's quite as big, in October, but it's shut for a week. Now, I think China, there was also some bad news coming out of China. They said over the weekend that state bank lending was down. And it was really upsetting to them. They didn't want that, and they're trying to throw monetary policy at it. And throwing monetary policy at it, when the market's in a terrible mood, have a lot of doubt, is really, I don't think it's going to do the trick. Because if your business is in trouble for whatever reason, because the demand isn't there, you're worried about government regulation that like the private tutoring business, it was billions and billions of dollars. They erased that in one shot. So if you're really worried about that, I go, hey Remy, I'm going to give you 50 basis points of cuts. You're going to be like, what is that going to do for me? So what they really need is, sort of fiscal stimulus, like a Keynesian stimulus. They'll put confidence back in the market. It is, at the end of the day, a confidence game, and there isn't any confidence right now. Do they get it by buying up some real estate and freeing up, balance sheets and getting that market moving again? They really don't want to do it, but I think without serious fiscal stimulus, it's hard to see monetary policy cuts, reserve requirement cuts doing the trick, because you can make money really cheap. If people don't want to borrow, it's not going to be any good.
Well, you and I, we've been talking about the state of the economy in China, so we'll see what comes out of that meeting. I'm sure you and I will be talking about it bright and early tomorrow morning for sure. So I do want to very quickly take a look at the name in terms of Intel, which is leading the Dow higher. So let's take a look at Intel. So this morning we're seeing that it is leading the Dow higher and is up by nearly 2% on the session. So Tai, I know you like to refer to this as a beauty pageant, but following Qualcomm informally approaching Intel about a takeover offer, a lot has come out this weekend, hasn't it? So what do you think is going to happen to the company?
It's interesting. I mean, it is a little bit of a beauty pageant. All of a sudden, you wake, in the morning. why am I looking at news on Saturday morning, right? Apollo wants to put in maybe up to $5 billion of a major investment in Intel. There have been whispers that maybe Broadcom will be interested. And Intel had some good news. They got the deal with Amazon. They got the deal with the U.S. military. But fundamentally, and as we've talked about before, it brings a little bit to mind, and and I hope Intel succeeds. I mean, it really is the quintessential American company for a really long time. Is BlackBerry, right? They were in 2010. Everyone had one. I had one. I loved the keyboard, and 2 or 3 years later, they were gone. And it's how brutal and the tech business is. And you worry about Intel because Intel still probably has the best chips that goes into personal computers. But with everybody on their phones, with AI, with different ways that the market is focusing, personal computers is just not that big of a market. And Intel revenue is down 30% in 3 years, which is really, really dramatic. So the question is, people have said, what, does Qualcomm really want this? Is this additive to them at all? And it's not clear really that it may help them. And because you buy Intel, you're going to bring you have an aging business. Do you turn it around? Are there really synergies? We're uncertain about that it will do so with Qualcomm. Apollo's been made big splashy investments. They're really smart folks. Something like that would help. I'll tell you what would really help is Warren Buffett took some of his cash pile and stuck it in Intel. I don't know if Pat Gelsinger has made that call, but I don't know if that's sort of Warren Buffett's thing, but some sort of, again, confidence in Intel. And there have also been whispers that Broadcom, which is much bigger than Qualcomm, might also be interested in perhaps taking a stake. But I think Intel would like the interest, would certainly like an investment to say, people still believe in us as a company, and we can come back.
And I think when we think about the potential, right, if Qualcomm takes over Intel, then there could be concerns about antitrust as well.
Sure. This FTC, Federal Trade Commission, has been very, very active in terms of any kind of combinations and mergers. In fact, I was reading that they are, I think Tempur Sealy, who bought Mattress Firm, the FTC is giving them a hard time and saying, you're going to really have a big footprint in mattresses, and it's going to be bad for consumers. They may well eventually be right. So I think any kind of major merger is going to lead to significant scrutiny. Certainly Lena Khan remains at the head of the FTC.
Yeah, I think that's one thing we'll have to keep our eyes on, especially as this story unfolds. And if we think about the past 48 hours, there's been a lot of news. So we'll see what comes out in the next 24 hours, Tai.
Yeah, and hopefully Intel has made sort of a market bottom, and might be investable, around these levels if they get a little more confidence.
And when we look at the price action for Intel, it is still down by about 35% year to date. So we'll keep an eye on this name. Now, I do want to very quickly take a look at other markets, Tai.
Sure.
So we were talking about what happened in terms of Eurozone PMI data and how the euro retreated. We also saw that German bond yields were lower as well. But I do want to do a recap, especially given last week, right? So we had the witching as well as the rebalancing of the S&P 500. What did we actually see in the final hours of trade last Friday?
So it wasn't that volatile, and as we talked about that expiration, we actually finished above 5,700, which was where sort of the day started. There was a little action between 2:30 and 3 o'clock when I think the S&P cash was at 56.60 or so, which would have been well below, which probably would have required some hedging by people who were short that strike, because again we closed above it, so you had to assume above it. So I think there was a little bit of selling, but it was generally not that volatile, and I think that's why sort of the triple witching I think wasn't really a sharp and aggressive one. We also had some index rebalancing, and if you looked at the names, those things are telegraphed way in advance, and I think there's a lot of algorithms who trade it now. And with the names who went in versus the names who went out, it was sort of a mixed bag, not a lot of dramatic moves in terms of any of those names. So, which means the market has functioned relatively well.
Yeah, that was something that we were keeping our eyes on as we headed into last week. But here we are on Monday, and we are back to business as usual. So very quickly, I do want to highlight two things that we're watching, and that is gold. So if we look at spot gold this morning. It is still trading above 2,600 and is higher by about 0.3% this morning. So gold touched a record last week, and we are seeing highs this week as well. So given that we have a lot of data points this week, what do you expect to see when it comes to spot gold futures?
So
spot gold.
I think gold is going to be a little bit like the stock market. It's really a risk. I look at it as a risk asset rather than really a safe haven asset at this stage. We have lower rates. It's in a bull market. It looks like it's just going to go grind higher. Is it going to finish at 2,700 or perhaps even higher? 3,000 is the number that a lot of people have in their minds. That's what the miners apparently are looking at, and that's where they want to start to hedge. Although, I suppose if you said, I want to hedge at 3,000, maybe I'll start hedging at 2,900 and get ahead of everybody else, right? Because that will move the markets a little bit. What I see for, if inflation remains under control, the employment situation remains decent, we could get a quarter's worth of a slow march higher in gold, a slow march higher in the S&P 500. I'd expect to see new records. Maybe a little early to say, could we hit 6,000? Probably, maybe a little too hard for this year, but I wouldn't rule it out. So a steady up 0.3% a day, some days up 0.5%. Really good for long-term investors who are in the indices. Actually really tough for hedge funds. They actually do much better and can outperform their benchmarks when there's a lot of movement in the market. If you remember in the late teens before the pandemic, when the market was just climbing and grinding up, hedge funds had a lot of problems beating the benchmark. And I think we could see that again, perhaps for the next quarter. Now, once again, there's external issues, wider conflagration in the Middle East, the U.S. election. Those are the two biggest things. But aside from those, if those pass relatively quietly, you could see just a steady, rising tide lifts all boats in gold, in Bitcoin, which is now as correlated to the stocks as they have been in a long time. The correlation is almost close to 0.7, which means they practically move together.
You brought up a lot of key points there, Tai, and as we head into the final week of the quarter, it'll be interesting to see central bank buying in terms of gold as well, and what it means on a quarterly basis.
Yes. Every month we look at the World Gold Council's report to see where central banks are doing with gold. Is there sort of price sensitivity that at these levels they don't want to add anymore? I think if you see central banks really stop buying, and the Chinese have already stopped buying, but if you see other banks stop buying, then it may take a little bit of the heat out of the rally. But right now it's a bull market. You can either be long or flat. You absolutely can't be short.
And you mentioned Bitcoin, so I do very briefly want to touch on that. So overnight we saw Bitcoin rise above the 64,500 level, and we're seeing both Bitcoin as well as ETH higher on the session, and this does come on the rally that we saw on the heels of that Fed rate cut last week. So do you think there is more room to run when it comes to the Bitcoin rally? So
Bitcoin's at an interesting level. I'd like to see it get back above, sort of make a new high above 60, maybe 66,000 to break this long downtrend of sort of lower lows and lower highs. I don't get the feeling that the energy in Bitcoin that we're going back above 70,000. It sort of just doesn't feel that way. And if everything's moving up steadily, you probably sleep better having your money in the S&P 500 than you would in Bitcoin, because for sure that thing trades 24 hours, and you never know. It's down $4,000. Why? Because it's Bitcoin. There's a lot of volatility in that. So I don't feel the energy yet, but it's certainly, it has done well. I'd expect it to continue to do better, with the rate cuts look like steadily on the horizon.
And also, we will be getting the debate between the VPs next week here in the U.S., so that'll be interesting to keep our eyes on, because the first presidential debate between Harris and Trump, we didn't get any mention of crypto, but we know that we're seeing headlines coming out of both camps.
Right. Harris has come out and said, been very positive on crypto. And J.D. Vance was a venture capital investor before he became senator from Ohio, so he should know a lot about that. And I guess the market knows J.D. Vance a little bit better from his best-selling book, Hillbilly Elegy, as well as he's been out on the campaign trail a lot. But most people have no idea who Tim Waltz is. As a financial sort of markets person, I'm just stunned that there's somebody who, doesn't own any stocks or bonds, or has anything other than his savings account and his pension. I suppose there's nothing wrong with that, but it seems maybe a little unsophisticated in these times. So it'll be really interesting to see that debate, to see if vice presidential candidates and debates have generally not really affected the election. But since it looks like we're not going to get another presidential debate, this one is well worth watching. I think it'll actually get, because of the characters involved in the polarization, a lot of attention.
Yeah. I actually am looking forward to that debate, and I'm sure you and I will be talking about it here the day after that VP debate takes place. But before we move away from potential risk events, it is a presidential election year. We're keeping an eye on what happens on November 5th. But of course, there's the potential of a government shutdown, and we've also talked about potential strikes affecting the supply chain in the U.S. But in addition to that, we're keeping our eyes on what's happening into the Middle East, and I think this is a great time to take a look at how it's affecting commodities, in particular oil, today.
So over the weekend, a lot of a heavy exchange of hostilities between Hezbollah and Israel. I think Hezbollah shot off 150, 170 rockets in Israel. Israel responded with heavy airstrikes all over southern Lebanon. It looks like this thing could really catch fire. Will there be a ground invasion? I don't know about that. And the last couple of times Israel has gone into Lebanon, it hasn't really gone well for them. But what they want to do is they want to degrade Hezbollah's ability to keep firing rockets. They've asked civilians to clear out of southern Lebanon, and I mean, on the one hand, I guess as an American, if someone started lobbing missiles into the United States, I think we respond very aggressively. So, I mean, northern Israel has been evacuated for some time, and I think they want to sort of get their people back. But it feels like there won't be a resolution anytime soon. Now, I think these concerns have given an underlying support to the oil price, both Brent and WTI, which have had a really nice run off the lows. I don't know if we're in a new bull market. I think something would have to happen. Iran is a supporter of both Hamas and Hezbollah. Will something happen in the Straits of Hormuz, where a lot of oil comes through? Will there be problems in the Persian Gulf? I think if that remains relatively peaceful, I think the crude rally will probably level off. We may have seen a short-term bottom, but I'm not quite ready to say that we're in for a rip-roaring crude rally. But certainly, the rally in crude has been noticeable, and a lot of it is the geopolitical concern between Hezbollah and Israel.
And of course, every week we pay attention to inventory numbers, and those will be coming out on Wednesday morning.
Wednesday, 10:30. They were quite low last week.
Yes. Yeah, so we'll have to keep an eye on what happens in terms of geopolitics in the Middle East, as well as what happens in those inventory numbers. So before we wrap it up for our segment, Tai, given that we have Fed speakers as well as the economic data to keep our eyes on this week here in the U.S., we also have the UN General Assembly taking place in New York City, so that means gridlock for traffic. And hopefully you and I don't get stuck in traffic if we're taking public transportation, but this also does mean that state leaders are going to be here at the New York Stock Exchange and also congregating in the UN, and it is also Climate Week, so it'll be interesting to keep our eyes on what comes out of that.
I know, I heard Javier Milei was just here. I would have loved to have gotten a selfie with him, but apparently there was a lot of heavy security. President of Argentina, really, trying to break the mold, the ultimate outsider. And Argentina has had decades and decades of instability. So, I'm rooting for the guy, to be perfectly honest. That whatever they've tried in 30 years hasn't worked, and maybe his formulation will be better. I know he's got some really smart people working for him. Actually, one of I think his economy minister, was in the J.P. Morgan training class with me about 30 years ago or so. Real smart guy.
Yeah, it is definitely a small world when we think about what we're talking about here. But of course, we'll keep an eye on what happens, what comes out of the General Assembly, because tensions are high in the Middle East. And even here in New York City, when we think about some of the rallies and protests that are taking place on the heels of what happened in the Middle East, you know, it really does speak to the tension we're feeling here in New York City.
Absolutely, absolutely. It's going to be a barn burner of the week. Well, you know, I think Netanyahu is supposed to speak. I think Biden will speak today, perhaps. So it'll be a really interesting time to be in New York.
Yeah, we'll keep an eye on what comes out of the UN, but very quickly, let's take a look at the markets before we head into our second segment. So right now, we are seeing the major U.S. stock averages continue to trade in positive territory. The Dow Jones Industrial Average barely above the flat line, but is up by 0.14%. The NASDAQ Composite Index is higher by 0.25%, and the S&P 500 holding on to session gains higher by 0.3%. And Tai, thank you so much for joining me for the first half. I look forward to speaking with you bright and early tomorrow morning.
Yes, indeed. Thank you.
And coming up, a special pre-recorded segment right here on Global Money Talk. We'll be right back. Don't go away. Welcome back to Global Money Talk live from the New York Stock Exchange. Today we have a pre-recorded interview with Gun-Young Oh, an economist at Shinhan Bank, who is widely regarded in Korea as the top expert on the U.S. Fed. What's special about this interview that you're about to see is that it was dubbed using AI technology. It took about 20% the time it would have taken a human to complete the dubbing, and AI did about 90% of the work with only about 10% requiring human attention. SamPro TV is pioneering the use of AI to translate financial content globally and is excited about the prospects of bringing more high-quality content generated through its vast network to our global viewers. Take a look.
Probably rarely seen the housing market so dominated by fixed-rate mortgages. It's hard to make a direct comparison, but I think he's reflecting on different factors here. The Fed has a dual mandate: balancing inflation, growth, and maintaining maximum employment. So they absolutely can't afford to risk disrupting everything else solely because they want to address this persistent housing inflation issue. So in a way, they're distancing themselves, saying, no, this isn't our issue, this isn't our responsibility. Instead, they seem to be targeting employment now by implementing the 50 basis point cut. That's how I would interpret it.
Yes, we're continuing on with part 2 of our insightful conversation with the beloved director Oh Gun-Young. Let's keep pushing forward with determination.
Yes, so you mentioned earlier about, so if we lower interest rates and inject money into the system while simultaneously performing quantitative tightening, what ultimately happens to market liquidity in that scenario? Well, we don't really know, but let me put it this way. Quantitative easing wasn't even conceptualized until the 2000s, when Japan first introduced it as a monetary policy. Because the banking system was failing, the collapse of Japan's bubble left their entire banking sector in ruins. Since the banks couldn't operate, the central bank had to step in, injecting capital to keep them afloat. So while the banks were essentially dead, they weren't allowed to fail. The hope was that eventually they would start lending again. Now, if the US banking system successfully revives and banks genuinely begin lending again at full capacity, but banks only increase lending when the real economy improves. So if US commercial banks rapidly increase their lending, then even with quantitative tightening, reducing reserve balances, liquidity only happens when those reserves leave the bank's balance sheets, right? So the key question is how much lending they're doing. Even if reserves are reduced, if lending takes off, the money supply multiplier effect kicks in and drives growth. So ideally, even with rate hikes or quantitative tightening in place, if the real economy is genuinely improving, money will begin flowing back into the system. In that case, even if the central bank absorbs money through tightening, banks can still inject liquidity into the economy with loans. At that point, there could actually be a noticeable increase in real liquidity circulating within the economy. So the question now becomes where the US real economy currently stands.
In a way, that also answers the question, will liquidity increase if rates are lowered?
Yes, but since we're on the topic, let's briefly detour for a moment. In early September, market sentiment was quite negative. People were saying, oh, this is bad. By the second week of September, even before the Fed cut rates by 50 BP, the market began to turn around. The first reason is Jensen Huang came out and said, Nvidia is doing great. That was the initial trigger, but that alone wasn't sufficient to create momentum. The second trigger came when journalist Nick Timiraos spread the rumor that the Fed would cut rates by 50 basis points, which caused quite a stir in the market. But there was a third factor, something not many people pay attention to. The third factor involves a man named Michael Barr. Who is Michael Barr? He's the vice chair of the Fed, and he basically oversees financial regulation. Yes, back in March last year, when SVB went bankrupt, Michael Barr stepped up, clearly furious. He said, "This is unacceptable. Banks can't operate like this. You must increase reserves," then pushed for doubling their capital reserves. People were shocked, saying, how is this even possible? So there was a huge uproar about increasing bank capital, and they pushed for much stricter regulations. They aimed to raise capital requirements for large banks and introduce new regulations for small and medium-sized banks that previously lacked them. If capital regulations are imposed, banks will need to set aside money for reserves that could have been used for loans. That reduces bank profitability. They're thinking, this isn't sustainable, we might go under. It also created tension within the Fed. I think Wall Street bankers have been heavily lobbying politicians to prevent this from happening. Then last week, Michael Barr appeared, apologized, and announced there would be no new regulations for small and medium-sized banks. For the large banks, he requested a small increase in capital reserves. When the US benchmark rate drops, the short-term rate typically falls, while the long-term rate rises, resulting in an inversion of the yield curve. Commercial banks generally borrow on a short-term basis and lend over the long term. With the regulatory uncertainty gone, the gap between the two rates widens. That makes it easier for banks to issue loans. And if the real economy can absorb it, then even if capital markets outside the banks experience some tightening, banks can still step in and fill the gap by actively pumping out more loans. That could serve as a stabilizing factor, limiting the possibility of a large-scale recession in the US economy as we might currently imagine.
Yes, I understand. So that's what happened. Shall we now look into the interpretation of the 50 basis point cut from this FOMC?
Honestly, regarding that 50 BP cut, I also expected them to lower by just 25 BP because, well, I was wrong, but if I had to make an excuse, here's why. First, though, there was this factor, like the August employment report released earlier this month wasn't that bad. I mean, was it great? No, but it wasn't bad either. Employment increased by about 100. It could have been lower, but even if it had dropped to around 100,000, it would have been fine. So employment wasn't in bad shape. And that's the first point. The second point is inflation in the US, especially housing prices, started to creep back up. It's hard to be reassured, especially with the housing market. It seems reaching 2% inflation will be tougher than expected as the latest data came out stronger. At that point, I thought a 25 basis point cut was already a given. The third reason was that just before this FOMC meeting, U.S. retail sales and industrial production data were released. Both reports came out solid, not bad at all. Seeing that, I thought, is there really a need for a 50 basis point cut? So after hearing what Nick Timmerhouse said and various other signals, I started wondering if a 50 basis point cut was coming. Still, I was expecting 25 BP. But when I woke up in the morning and saw 50, my eyes widened in surprise. I was curious, why did this happen? Of course, Chairman Powell held a press conference. Naturally, reporters thinking the same thing started bombarding him with questions, asking exactly what I was wondering. They asked, employment was good, inflation was high, retail and industrial data were strong, so why did you cut by 50 basis points? You said in July you weren't considering 50 basis points. Why change now? So let me briefly summarize a few key points that Powell made during the press conference. First point, the first thing he said was, when asked, Timmerhouse pointedly questioned, you were late with this decision, weren't you? Powell responded, no, we weren't late at all. You have to phrase these questions carefully. Who's going to admit, yeah, I'm an idiot, I messed up, when asked like that?
Basically asking Powell, weren't you a bit late in cutting rates?
He firmly said, absolutely not. This reporter asked a really good question. You remember back in July, around the end of July and beginning of August, when that economic data was released, it came out pretty bad. So at the July FOMC meeting, people asked, hey, if you'd factored in that data at the time, what would you have done? During the press conference, they asked, if you had considered that data, wouldn't you have cut rates? Powell responded with something non-committal like, maybe, maybe not. So someone asked again, since you didn't cut rates in July, did that factor into your decision now? Powell didn't admit they were late. Then he was asked if not cutting rates in July had been a concern of his. Powell neither confirmed nor denied it. So when you look at that, you realize they were being very cautious. So what this means is, the first thing seems to be that they probably felt they should have cut rates in July, but they were a bit late. Yes, but to be honest, that's not a huge factor. The bigger issue is the second point. There seems to be a significant difference in how they're viewing employment. This difference in how they're looking at employment goes like this. Let me explain. Earlier, I mentioned that if employment increases by around 100,000, that's considered decent, right? I was taught the same. 100,000 is a good benchmark. If 100,000 people are hired, that isn't too bad. But here's what Powell came out and said. Even with 100,000 jobs, there could be a problem because there's been a huge influx of immigrants. In the past, the workforce grew by about 110,000 each year, so the number of people available for work increased by 110,000 each month. If 110,000 people are joining the workforce every month and 100,000 jobs are created each month, the unemployment rate stays stable. But now with the surge in immigration...
You suddenly need a lot more jobs?
Exactly. If you're still creating just 100,000 jobs, then unemployment goes up because there are more vacant positions. So Powell says 100,000 jobs is no longer enough. At the current economic level, if we continue creating only 100,000 jobs each month, the unemployment rate will inevitably rise. That's what he's saying. The world has changed. Interestingly, a guy named Goolsbee said the same thing a week before. Goolsbee made those comments a week before Powell's 50 basis point cut, and Powell echoed the same thoughts later. So the takeaway this time is pay attention to Goolsbee. Goolsbee is Powell's closest confidant. Instead of looking at Timmerhouse, we should be focusing on Goolsbee. The second thing Powell discussed, let's keep it simple here, avoiding any complicated terms or jargon. This is the state of U.S. jobs right now. Initially, there were 6 million workers available in the labor market, while there were a staggering 12 million job vacancies waiting to be filled. So that's 2 job openings for every 1 worker, a 1.2 ratio. When every worker has 2 job options, they can pick and choose. That means we're short by 6 million workers. So after strong tightening, what happens is the number of vacancies starts decreasing. If workers can choose, which jobs do you think they'll go for? Usually when they have options, they'll choose the jobs that pay the most, right? That drives wages up. If that situation continues, rising wages will fuel inflationary pressures, which is why the thinking is that maintaining high interest rates will start reducing jobs. Yes, so jobs have decreased and now we're down to 6 million, reaching 1:1 ratio. We're at 1.1 now, but let's take a look at what this means. Even with a 1.1 ratio, if we maintain high interest rates, jobs will decrease further. At that point, it's not just about having fewer options, it's about jobs disappearing entirely. From then on, the unemployment rate could start rising significantly. So what we've seen so far and what's to come will look very different. The first point is that immigration has increased. And second, the ratio of job vacancies to workers is now 1:1. From this point, if jobs decrease, it will be directly reflected in the unemployment rate, which could cause a sharp rise in unemployment. Why is this happening? Some might say it's because the economy is strong and immigrants are arriving, raising unemployment. Looking at August's unemployment data, when the rate rose, people called it Sam's rule, causing a huge fuss. Looking at things like that, it's clear that market sentiment could be quite negative. The fear of a recession can lead to self-fulfilling prophecies, causing real impacts on the economy. That's why, from the Fed's perspective, adding 100,000 jobs a month isn't the solution. If they continue this way, the unemployment rate will rise. Secondly, from now on, if job losses occur due to tightening, the unemployment rate could spike. There's no solution to that. I think they're very aware of this. It seems the framework through which they view the labor market has shifted. 100,000 jobs won't cut it anymore. They'll need to create more than that. Now they have to start creating jobs. This isn't about maintaining the status quo. They'll need some kind of invisible stimulus. Secondly, from now on, they must take every possible step to prevent job losses from occurring. That's why they considered a 50 basis point cut this time, as it aligns with their current view of the labor market's fragility. If you take a close look at the FOMC's summary of economic projections, you'll notice they've directly referenced this concern. Back in June, they projected the unemployment rate would finish the year at 4.0%, not expecting it to rise significantly beyond that. But now, it's projected to reach 4.4%. It's increased quite a bit. Even though the Fed says they'll cut rates 4 times by the end of the year, the unemployment rate is still expected to stay at 4. This means it's now easier for the unemployment rate to rise compared to the past, as the economy has become more fragile. They expected it to be around 4.2 or 4.1, but it's now holding steady at 4.4 for a while. Despite these rate cuts, this indicates something deeper about the underlying conditions in the labor market. It indicates that from now on, there's a much higher possibility of the unemployment rate spiking. The structure has changed. It's a different game now, and it seems like the Fed is recognizing that. So this has become a surprising realization for them. In the end, that's why the Fed decided on the 50 basis point cut. That's how I interpret it.
Yes, that makes perfect sense. It's very convincing. Given this context, the dot plot projections also appear reasonable and align well with their overall strategic approach.
Now the dot plot has been revised and all that. But one thing that genuinely surprised me during this FOMC meeting was a reporter asked, "What about housing market inflation? Home prices have certainly gone up, haven't they?" Powell responded, well, this is actually quite difficult to address. What's difficult? Raising interest rates has kept fixed rate mortgages around. So people treat those low interest loans like a badge of honor. Why would they sell their homes? That's why there's no inventory. So if we lower interest rates, wouldn't more homes come onto the market? So the reporter asked, if we lower interest rates, are you saying home prices will drop? That's what it sounds like, right? Then Powell made an intriguing point, saying, reducing interest rates could lead to more homes being listed, but it would also undoubtedly increase the number of eager prospective buyers entering the market. So even if more homes are listed, more buyers don't necessarily mean prices will fall, right? He concluded saying, that's not something the Fed can control. I may have said that a bit humorously, but let's take a moment to consider this. Let's briefly look at this article. It was translated by the Korea Economic Daily. The question was, what are you going to do about home prices? The response was, people are holding on to their low-interest mortgages, so refinancing is too expensive and they aren't selling. So raising rates won't fix that. But if rates go down, people will finally sell and move, leading to more homes on the market. Then you might think prices will drop, but new buyers will also emerge in the market. The real issue is that there simply aren't enough homes available. We all know that. You, me, and everyone else knows it. It's hard to find land in places where people want to live, and every aspect of housing is becoming more difficult. This is not a problem the Fed can solve. It's a supply issue that the market and the government need to address. Then he wrapped it up. Basically, he's saying, this is out of our hands, right?
Then what does the central bank say?
So, from the Fed's perspective, if you take a look at the article above, here's what they are clearly stating. It could take several years, definitely not just one or two, for housing inflation to gradually go away.
Does that mean they will choose to exclude housing from their inflation considerations moving forward in their assessments and evaluations?
They won't exclude it, but they'll likely take it into consideration in a different way. So here's the thing, they still need to address it. So they're saying, sure, if we could control it with high interest rates, you'd be right, but we really can't fix it. And if we try, are we willing to risk everything else, including the labor market, just to address that one issue? That's why they're not going to consider going down that path. So from the Fed's perspective, they're essentially declaring that they don't know what to do about rising home prices.
That's very different from the Bank of Korea.
The system is indeed different, isn't it? There are various factors and nuances that set it apart, right?
We have variable interest rates.
Yes, the systems are different. In Korea, lowering rates won't necessarily lead to more homes being listed. Chairman Powell, for example, has probably rarely seen a case where the housing market has been so dominated by fixed-rate mortgages like this. It's hard to make a direct comparison, but I think he's reflecting on different factors here, because the Fed has a dual mandate. They have to balance both inflation and growth. And of course, they also need to maintain maximum employment. So they can't afford to risk messing up everything else just because they want to tackle this sticky housing inflation issue. So, in a way, they're distancing themselves, saying, this isn't our issue, this isn't our responsibility. Instead, they seem to be targeting employment now by implementing the 50 basis point cut. That's how I would interpret it.
I see. Are there any other key points worth discussing?
Looking at the Fed cases, let me mention one last important thing before we move on. It seems to be closely related to how they perceive the neutral interest rate and its implications.
That's what we are curious about. Where will the interest rate ultimately stop?
They lowered the rate by 50 basis points this time, but there was one notable person who opposed this move. It was Michelle Bowman, one of the board members, and she's considered a hawk. Quite hawkish, actually, in her views. Michelle Bowman is also a governor, and she's on the board of the Fed. She holds a significant position. I'm not sure, but I've been watching the market since 2004. I remember back in 2005 or 2006, a few regional Fed presidents voted against the decision. James Bullard did it, and so did Esther George, among others. That's possible because they could say, our region is different. They represent their region's interests, and that's understandable. But I don't really remember a Fed board member casting a dissenting vote. I can't recall it. Yet, a board member voted against this time. I only read about it in a book. I have never seen it myself. There's this hallway in the Fed near where the chair's office is. Apparently, before the FOMC meetings, they bring in all the board members and put them on the hot seat. Like, let's go this way going forward. That's how the Fed chair persuades them. Even Ben Bernanke used to do this. When it was time to spend money, the hawks would say, no, absolutely not. Then they'd be convinced with, let's try it and stop if things go wrong. There seems to be a manual of sorts for persuading hawks. But when hawks are involved and you propose a 50 basis point cut, they'll definitely put up a fight. So they probably spent a lot of time figuring out how to convince them. This is what they came up with. The best way to persuade hawks is to convince them that we are focusing on the long term. If we cut by just 25 basis points and a recession hits, we'll have to cut much more later. But if we cut by 50 basis points now, we won't have to cut as much later because the real economy will hold up better. So for the greater good in the future, let's cut more now to prevent bigger cuts later. It's like giving a preventive shot. That's how they could convince them.
Ultimately, they're trying to maintain high rates.
Right. And from the hawk's perspective, it makes sense. And when the chair comes into your office and talks for a while, it doesn't seem like you'll leave without agreeing. But Bowman still cast a dissenting vote, like no way despite all that, but that's how they operate. In the end, the idea is to cut more now so that they can cut less later. If they choose to cut a lot now, they can immediately support the growth of the American economy. The growth is solid and organic, and that way the U.S.'s potential growth rate won't be damaged. Then there won't be a need to cut rates further. That's why the long-term neutral rates went up. This time, the longer-term rate actually climbed from 2.8 to 2.9. While most rates have dropped significantly compared to June's projections, they've actually raised the long-term rate. By lowering the rate this time, they're actually supporting the real economy's growth potential. That's the message here. So looking at the article, I want to share some thoughts. When Powell was asked if he thinks the era of significantly lowering rates will return, he basically said, I don't know for sure, but personally, I don't think we'll return to the era where the neutral rate was negative. And now it seems the neutral rate has become significantly higher compared to then. How much higher? We don't know yet. That's what he said, but it seems we'll be operating at a higher long-term base than we did in the past. Yes, I think this was Chairman Powell touching base on this subject once again.
The real interest rate, considering inflation.
Exactly, so we can see this from the content. Now, to summarize, we had the central bank week recently. We haven't seen the BOJ yet, but although they kept rates unchanged, I haven't watched the press conference, but if you look closely in Europe, they're starting to think about quantitative tightening. So the Fed will likely continue grappling with quantitative tightening. They're going to have to continue battling the market, which will want them to end it quickly. But Powell has thrown a bit of a curveball here. First, there's the hawkish aspect of this case. Second, raising the neutral rate is another hawkish aspect. These are two key points. Another question is then, why did the Fed rush to lower by 50 basis points? This would be how they explained it to the hawks. This way we won't have to cut as much later. To the doves, they said, the framework has changed. We need to prevent unemployment from rising, as more job losses will put us in serious trouble.
It seems like they've realized the framework has changed a bit late, if that's the case.
Yes, when I looked at the press conference, they mentioned this. Let me check again. During the press conference, Neil Irwin asked a question, and this is what Chairman Powell had to say. He said that job creation heavily depends on labor force participation. He's pointing out that many immigrants have entered the labor market. If only 100,000 jobs are created while millions join, the unemployment rate will inevitably rise. This is the first point. And if you see below, the second question isn't particularly important. The entire committee thought that because there are too many job openings and too many job seekers, we might reach a point on the curve where this leads to an increase in unemployment or job losses. This is called the Beveridge curve, but let's skip that for now. We are very close to, or may have already reached that point. So if job openings decrease further, it will directly lead to unemployment. What this means is there are no excess jobs left. It's now a one-to-one match. So any decrease from here will result in an increase in unemployment. So this FOMC press conference had a lot of important details to listen to. Personally, it was pretty shocking. So far, Powell has been giving rather ambiguous, iffy statements, but this time, he worked very hard to provide a detailed justification for the 50 basis point cut. So I think this was an opportunity where we could really get a good sense what the Fed is thinking and struggling with.
Yes, in fact, they may have been hiding those concerns under inflation issues all along. Then there's the important question many people are asking. Are we recognizing the start of a recession, and are we perhaps reacting a bit too late? If that's the case, with the time lag in policy responses, some might suggest that we should assume it will be difficult to prevent the recession and plan our investments accordingly. Or is it more like, no, inflation has been mostly controlled, the economy isn't that bad, and we're just lowering the rates we previously raised due to inflation, so there's nothing major to worry about? Which perspective should we adopt moving forward?
On August 5th, it was described as a yen carry trade unwinding, but in fact it was actually due to fears of a US recession. The Fed and the Bank of Japan probably realized how serious it could be after seeing that unfold. Then they likely thought, wow, this is scarier than we thought. The unemployment rate is rising for reasons other than this, and it's still concerning. The Fed must have realized that the public sentiment toward a recession is quite peculiar. So while we're not yet seeing clear signs of a recession, if the recession comes and the unemployment rate jumps, as I mentioned earlier, people start making it a self-fulfilling prophecy. When people keep saying the recession is here, and they stop spending money, don't they? An actual recession hits. So the Fed seems very committed to taking on any and every possible measure to preemptively defend against that. Personally, I'm not entirely certain whether a recession is on the horizon or not, but I do believe there's ample room for the Fed to make a mistake. If a recession does hit, I firmly believe it will be largely because the Fed made an error in judgment. The reason for a potential Fed mistake goes back to what we discussed earlier regarding their policies and approach. The market has become too smart for its own good. It almost reacts too quickly to policy measures now. The market has significantly outsmarted the Fed, picking up on signals much faster than it ever did in the past. So from the Fed's point of view, even the Bank of Korea's governor made a comment about this. He said, the rates have dropped too much and we haven't even lowered rates yet. Because we have to realize everyone is anticipating it. It's bound to go down. Everyone is waiting for it to happen because they've learned too much. So even before the rates are officially lowered, they've already dropped. then just adjust to match it, right? This is the tiger from the sun and moon story. The tiger doesn't just take one rice cake, it will appear at the next ridge. So when do you decide to go home? The sun and moon will come to find you, but the tiger ultimately meets its end while pursuing this. The market will keep coming back to take everything it can get. It's an endless cycle, really. From the Fed's perspective, they can't fill in for the market forever. They do their best to satisfy market expectations, but at some point, things have to change for overall economic health. This creates a kind of discrepancy in the economic landscape. So if we're looking to identify risks, particularly recession risks, I believe the Fed is in a very challenging position. The market has become incredibly savvy, and the Fed now has to orchestrate a soft landing while keeping that in mind. This is a significantly more difficult task compared to what they faced in the past. As I mentioned earlier, it's like everyone has a navigation system, which means the market reacts so fast. It's not easy being the Fed.
The economy is susceptible to immediate turns, depending significantly on the behavior of the market participants involved. Very curious to see how people will react to these indicators. From the Fed's perspective, they can't fill in for the market forever, no matter how much they want to. They do their best to satisfy market expectations, but at some point, things have to change for overall economic health. Well, we received some great insights and thorough interpretations of the FOMC's actions, all thanks to Director Oh Gun-young's expertise and perspective.
Yes, thank you kindly.
And that will do it for Global Money Talk Live from the New York Stock Exchange. Thank you so much for joining us. We'll see you back here tomorrow morning. Have a great day.